There is a lot going on in the world right now, especially in the political space. And if you are an investor and you're someone who cares about your money and how long and how hard you have worked for your money, this is a natural question, especially right now. What in the world should I be doing with my investments? How should I change my portfolio or make adjustments to my portfolio? Or should I just leave things alone? Let's go ahead and break it down. So it has been, again, a rough few days. It's been a rough year. Anytime there's an election, things get a little wonky, but let's admit it's gotten weird the last several years. But the last, what has it been, 3-4 days, it's gotten off the rails, okay? Now, we're not going to get out into all of that. We are going to get into the portfolio and the investments, because that's the only thing I am really qualified to discuss. And I've got at least two stats that are really going to stand out and going to help you to navigate this time for your portfolio. And I think it'll give you a lot of clarity on what you may want to consider during this time. Also, now, I like to make these changes in June. This is also mid-year. It is still mid-year, and it's a great time to step back and look at your portfolio to see, are you in good shape? Is this a time that you may want to buy or sell a certain stock or make tweaks to your portfolio, or just stop and look and just make sure that you are where you should be in terms of your investments. So first thing is first. Index funds. Okay, now we've talked about index funds before. You likely know what an index fund is. For those that don't, these are investments that hold an entire sector of the stock market, for example, or entire area of the stock market. For example, an S&P 500 index fund, we've talked about those before. They hold the top 500, the largest 500 companies rather, in the United States. Okay, that's an entire piece of the stock market. That is one of the best places, in my view, and the view of experts, and Warren Buffett, one of the best investors of all time. Okay, that is one of the best places for you to be. The reason why that is the case, other than all the other places that you can Google and find out that that is the case, right, but especially during an election season, is because regardless of what happens, you are going to have something that's relatively stable. Now, there is one thing that you should know about that. Okay, I'm gonna tell you this before I get into that. Okay, I'm gonna tell you this. About 80% of my own money, okay, I put my money where my mouth is, about 80% of my own money is still in index funds. That's not gonna change, okay? About 90% of my kids' money is in index funds, and that's not going to change, okay? So I'm putting my money where my mouth is, and regardless of what happens in November and beyond, I am not going to change where that money is. It is staying in that index fund, okay? But index funds are broken. And what do I mean by that? 70% of the returns that we all made from index funds last year came from just 10 stocks. That was it. That was it. Okay, so last year, if you owned an index fund, you made it right around 25%. 10 stocks within that. You can go into you can go to Yahoo Finance or just look in your app and it'll show you the top 10 holdings. Sometimes it'll give you a pie chart, say, hey, these are the top 10 stocks that are within this. It'll likely say, and I can almost tell you this from memory, but it'll say, I'm sure it's going to tell you NVIDIA. It'll likely show you Meta, a lot of the tech stocks, Google, Microsoft, already said Meta, maybe Netflix is in there. It's going to tell you the top 10 most valuable companies in the world, right? Or at least in the US, okay? And those companies are responsible for 70% of the returns, all within that 10. That's very, very heavy. And of that 25%, right, again, 70% of the returns are just at 10, 30% of it came from NVIDIA by itself. NVIDIA was putting in work, okay? So just know that a lot of it is very, very heavily weighted towards those stocks alone. This brings me back to the point of why I have been talking about energy stocks. We did a whole video about that last week, and it's why I still talk about individual stocks every now and then and say, hey, look, it does make sense to own energy stocks. It might make sense to own a dividend stock here or there outside of what you have inside of those index funds, because if 70% of my returns are all tech stocks, I don't also want to have another tech stock or own NVIDIA as a single stock and have all my money in index funds. I just got too much, right? Especially if 70% of my returns or 30%, right, within that index fund is NVIDIA, and then I've got another 10 or 15,000 in NVIDIA. What are you doing? Right? That's a lot. That's doing too much, right? I have way too much risk in one single company when instead I can have that and have my One Energy stock and have my finance stock and really kind of get a better sampling and get my veggies and my dessert and all types of stuff where I can have a better meal when it comes to a well-balanced portfolio, right? I think we made sense of that analogy there. So just be aware of it. Be aware of it. But if nothing else, if you did an index fund, you're in a good spot. There's nothing you really have to worry about or make any adjustments, any major adjustments in that way. The other thing is, when it comes to shocks in the stock market, I know we are all concerned about the next big thing, the next big recession. There are people on Twitter and Instagram and Facebook, and there are articles every single day. Somebody who called the last recession says that the next big one is here. There's somebody on YouTube with some headline, and I don't do the next big one is here, but y'all know what it is. It's always some goofy looking face, right? That has something, the big one is here, okay? Whatever, right? It happens. People are always trying to predict the next big thing, whether it's Robert Kiyosaki or whatever, right? It's always somebody. When it comes to the stock market, though, here's what we know. You never really know when it's coming. And if you think you see it coming, that's probably not going to be the thing. And here are a few examples. The last time that we all thought that it was going to be an election that was going to cripple everything, you could say it was 2020. You could say it was before that in 2016. That wasn't it. I mean, go back and read all the headlines. Go back and check your timelines, right? Go all the way back. It was a rough time if you go back and through your Facebook back during those times. But if you scroll back long enough and go back and Google further enough, you'll see that people thought that those were going to be things that would cripple the stock market, cripple the economy, cripple all these things. And that actually wasn't it. What tanked the stock market was an unforeseen pandemic. Remember last year when everybody thought it was going to be a recession, and that was what was going to tank the stock market or continue to tank the stock market in 2023? That's not what happened. That is not what happened at all. Didn't happen. Did not occur. When you think about the .com bust, when that occurred, people were saying, well, hey, I think these companies are overvalued. It wasn't until almost 2 years later until it actually started to occur. People were like, hey, these aren't really valued in that way. And then eventually it happened. You can call a major crash year after year or day after day after day, and eventually, sure, one is going to occur, but it's usually not the one that you see. Now, unfortunately, just like we've seen in the last 2 or 3 days, there can always be a powder keg, an international conflict, a domestic conflict that can throw things into absolute chaos. But that's not something that you can sit up and brainstorm and change your portfolio over, nor should you, right? There's a lot of stress and a lot of chaos in your own mind, which is not something, again, that I would advise anybody do. But that's, again, it is never going to be something that you know is coming and that you are going to be able to adjust for in advance, because the people who, let's say 1998 or 1999, that were trying to adjust their portfolio and do all this stuff, you missed out on a year and a half of gains until that crash happened. And you're like, well, wait a minute, right? I never made up for that year and a half. Then the stock market crashed, and then you didn't know what to do, right? So had you stayed invested the entire time, you would have made up for those gains and more, the exact same way that people would have missed out on those gains during the COVID era and would not have made up for that either. So be very careful of that as well. But now, moving back into the party side of things, there are a few stats that you want to know there as well. And I want to pull up these stats so I can be as accurate as possible here. All right, so when it comes to the party side of things, I'm just going to tell you this up front. Regardless of who wins in any election ever, okay, from this point forward, and really going back since the time I could ever vote, okay, going back to all the way then up to now, forever and ever, presidents get far too much credit for the economy and the stock market. And I cannot stand, I'll tell you right now, I cannot stand all the memes that I see when the stock market is doing bad. Whoever is in the stock market or whoever's in the White House, the stock market is bad. I get all types of memes. I don't know why I get the memes. I don't know. I don't know these people. But when it happens, they'll throw up all these memes in these groups and get real upset. The market is up, no memes ever. You never get, same thing with gas prices as well. When gas prices are up and people are upset, you get memed. They get memed, not me. They get memed, they get upset as if they have a button. Why would they raise gas prices if they had a button and controlled it, right? Doesn't make sense. But they get way too much credit and blame for the stock market and the economy. The fact is, it's really about Congress, and we have data to support this as well. When there is a mismatch, Democrat and Republican or Republican and Democrat in the White House and Congress, that is usually the best case scenario for the stock market. The reason is because the stock market prefers usually the status quo, meaning they'll look and say, oh, whatever the status quo is predictable. We can do our financial forecast. We are going to keep doing whatever we're doing. And in this case, when the market is up 25%, they're going to look and say, hey, we know what's going to happen. We're going to continue doing what we're doing. Everything's going to be fine for us. And they're going to continue to do that. Now, is that good for the consumer? Conversation for another day. Okay, but that is what they would prefer. When they see that, oh, there's a Democrat and a Democrat or a Republican and a Republican, things can be volatile. I don't know which direction it's going to be because it depends on what policies they may pass. It could be a more aggressive tax law, which could tax those businesses more, reduce those, reduce their profitability, and the stocks could tank. That could be it. Or, right, you could, put money in the hands of the middle class or whatever, and they can spend more money at those businesses and they get more profitability. I don't know, right? Or they could cut taxes and they get more money. There's a whole bunch of things that could happen, but you see how wildly unpredictable those things could be. But the thing is, if they are in the same party, they can, and it's if, right? They may not pass anything, but they could pass a whole bunch of things and change a lot of stuff, which is unpredictable, and we don't know what is going to happen. And neither does the stock market, neither do these CEOs, and neither does the investor. We have no idea, and that makes the stock market a bit more volatile. So that is what you want to pay attention to. And when it comes to Congress really, I guess because it's like 500 and some odd people, 562 or something like that. Perhaps I'm wrong on that number. I'll put it somewhere on the screen. But remember, Congress they're kind of, because of so many people, I'll say that, they get off the hook. So remember, when it came to inflation, right now, whoever's sitting in the presidency is the one who gets blamed for inflation. Remember, inflation was a combination of things. Yes, it started with the pandemic, but it also was, we know how inflation starts because there is too much money chasing too few goods. A part of it was because we had supply chain issues. That's not a presidential thing. We talked about this years ago in previous videos, did we not? Right? And then a part of it was because we, had too much money. We could bid up on stuff. Why did we have too much money? Think about that. Why do we have too much money? I ain't never got too much money, right? I want you to have much money as possible too. But for the sake of argument, why did we have too much money? Because for some people, we didn't have to pay student loans. Where did that come from? There was a law that was passed. That law was written by Congress. Now, to be signed by the president, but it was written by Congress. They are the ones who paused the first student loan payments way back in 2020. They did that. They were the ones who wrote the law for the stimulus checks. They were the ones who did the business loan program or whatever, and then forgave those loans. They did those things and put out a lot of that COVID relief money, which is probably generally a good thing, right? I'm not necessarily disagreeing with that, but that was a part of the effect. So those three things did help to contribute to inflation. Now, I also got the third or fourth part, which is I could be a company, I could be raising prices just because at this point. That's there too, right? But those three policies, right, written by Congress, nobody's really blaming that on anybody. It's just kind of there and nobody's paying attention to it, right? But again, that is a factor, but we don't always pay attention to it. But here's the thing for you as an investor. You cannot, and nor should you, try and predict what Congress's makeup is going to be, because at least for the House, every 2 years, something happening, right? They rotating in and out, and you got Senate rotating in and out. They're on schedule, I think, every 6 years or so. That's far too much for you to try and figure out across every state and for you to try and adjust your portfolio. So it makes more sense for you to stay focused on, your portfolio, and most importantly, staying invested regardless of what the situation, what the makeup is going to be. And the New York Times has some data to show that. So what they did, they actually did this with Vanguard from 1977 all the way through May of 2024. How much money would you have had if you invested in the S&P 500 compared to what you would have for each party and then in cash? So for example, from 1977 to May of 2024, what would happen if I just invested only when Democrats were in office for president and then flipped it? What if I only invested when Republicans were in office? How much money would I have? And then what would happen if I just left it all alone and just invested and did nothing? Okay, put $10,000 in 1977. If I invested only when Democrats were in office, I would have $849,016. A big number. Great. If I invested only when Republicans were in office, $162,578. If I invested the entire time and didn't touch anything, $1.6 million. The moral of the story is $1.6 million. Leave the money alone. Don't try and, make things more complicated on your own. Now, there is someone who's saying, well, what about that gap between those two parties? What the New York Times says is that's still not a significant, there aren't enough presidential terms. What is that, 46 presidents, I guess? Now, the stock market I don't think goes all the way back to George Washington. Okay, I could be wrong, I don't think it does. So we don't have, you need more, I think you need a minimum of like 50 samples or something to have a good statistical analysis. So we don't have enough presidents to really give you strong statistical analysis. Okay, so that's number one. But do you really want the 800, are you really going to take 800,000, 850,000? You want to take the 1.6 million? Shoot for the important number, okay? Focus on the big number, which is 1.6 million, and just stay invested the entire time. I think that's the main thing. But the numbers are the numbers. And they also say that though that is true, and also the time difference is about the same. So there was about 24 years for Republicans in office and 23.5 years for Democrats, because currently there's a Democrat in office, so they have a time advantage for Republicans right now. But even if you go back to the 1900s or to the year 1900s, the stock market tends to do slightly better for Democrats during that time. We have to go back and see why. But again, moral of the story, you make more money when you stay invested. I think that is the key. We're not going to be able to predict the next big disaster, which I don't think anybody wants to do anyway. But when it comes to at least seeing, right, what you may want to at least adjust your portfolio to, and we had talked a lot about what Congress is doing, it might make sense to see at least what they are investing in. If you want to see what some of your favorite politicians may be investing in, I don't know if favorite is the right word, but if you want to use that word, you can see what some of them are investing in. So I actually pulled some of the stocks that they are buying and selling right now. If you want to see what some politicians are currently buying and selling, you want to check out this video right here.